Hey, what's up, everybody? Doug Shoemaker here with your weekly market update. Now, for my friends out there who just want to know what time it is, here is your Cliff Notes version. The Fed is actually expected to cut the Fed funds rate by a quarter of a percent this week, but mortgage rates unfortunately aren't going to move because of it, because that pricing adjustment has already been baked into mortgage rates. So what really matters is that the Fed's dot plot is coming out on Wednesday, and then the next jobs report that's going to come out in early October, that's what's going to have a big impact. So if the job market actually weakens, we could see lower rates. If it surprises to the upside, then rates could move a little bit higher again. So right now, conventional 30-year rates are averaging around 6.25%, and government loans like VA or FHA are just a hair over 6% at 6.01 today. Now, keep in mind, these are the national averages. This may or may not be your interest rate based on a whole lot of other circumstances, but that's exactly what we can talk about if you reach out to me for a consultation. So that's the short and sweet version for those who just want to know what time it is. So now, for my people who love to know how things work, they love to know how to build the clock, let's dive into some details. So the Fed is going to meet this week, and while a 25 basis point cut is pretty much certain, the real story is actually going to be the summary of economic projections and the dot plot. So that's where Fed members actually lay out where they think rates are going to be headed next. Now, markets are pricing in 3 cuts in total for 2025, but if the dots show fewer than those 3 cuts, then you could expect some upward pressure on mortgage rates. Now, that's right, folks. Rates could still go the other direction. They could still go up, even though we think this is a decreasing rate environment. So, why is the Fed actually cutting? Well, this is because the labor market showed some weakness. The August 1st and the September 5th jobs reports showed some real cracks, and that's what pushed bond yields and mortgage rates lower. Now, remember, mortgage rates move ahead of the Fed announcement. So, for anybody thinking this week's Fed cut is going to bring even lower mortgage rates, the reality is, as I said before, it's already been priced in. So the Congressional Budget Office, or CBO outlook, adds to that story too. Sluggish growth at 1.4% in 2025, unemployment peaking at 4.5%, and inflation ticking up to 3.1% because of tariffs. On the flip side, those tariffs are actually projected to reduce the deficit by $4 trillion over the next decade. Meanwhile, the University of Michigan's Consumer Sentiment Survey shows 65% of consumers expect unemployment to rise in the next year, another sign of pressure on the Fed to actually keep easing that Fed funds rate. Now, technically speaking, bonds are in a really tight range with the 10-year between 4% support and 4.13 resistance. The Fed's tone on Wednesday and Powell's press conference they're going to likely dictate which way this thing breaks. So here's the bottom line. The week's Fed cut is not going to do much for mortgage rates. Wednesday's dot plot could create short-term volatility. Now, the big risk for major rate movement is still in the October jobs report. So, hey, don't get distracted by the headlines. The jobs data is still the driver. And remember, headlines come and go, but strategy wins every single time. So that's your market update for September 15th. Rates may or may not always be predictable, but there's one thing you can always count on, and that's going to be me keeping you in the loop without a bunch of salesy jargon. So until next time, stay smart, stay informed, and I'll catch you in the next update.